The tax system is not broken, it is working exactly as designed, and the people it was designed to help are not you. Every year you file your taxes and pay whatever number the form tells you, and every year the people who understand what I'm about to show you pay a fraction of that number, legally, using the same tax code you're filing under right now. The difference is not income, it is not a fancy accountant, it is knowing where the back doors are built into the system. Today I'm showing you 5 of them. One of them alone could change what you owe this year. Stay until cheat code 5, because that is the one that works at almost any income level, and almost nobody talks about it. You have been paying full price for something that has a discount window, and nobody told you where it was. Every April, the same thing happens. You gather your documents, you plug numbers into a form, or hand them to someone who plugs numbers into a form. A final number appears, you pay it. You feel vaguely terrible about it, and then you go back to work to earn the money to pay next year's version of the same number. Here is what that feels like from the inside. You look at your paycheck and see what was taken before you ever touched it. Federal, state, FICA, Medicare. By the time the money reaches you, 25 to 35% of what you earned is already gone, and you accepted it, not because you agreed to it, but because nobody explained that the form you're filling out is not the only version of the form that exists. The emotional cost is not just financial, it is the quiet suspicion that the game is rigged, that the people with more money have access to a different set of rules, that no matter how hard you work, a fixed percentage of it will always belong to someone else first. Here is the root cause. The tax code is not one set of rules, it is 2. There is the default path, the one everyone walks automatically, and there is the optional path, the one that requires knowing the right questions to ask. The optional path is completely legal. It is in the same document as the default path. Most people never walk it because nobody points to the door, but here is what most people miss. The cheat codes are not hidden. They are published. They are in the IRC, the Internal Revenue Code, available to anyone who knows what to search for. The wealthy do not break the law. They read the footnotes. Today, you read the footnotes. Cheat Code 1, the Augusta Rule. The IRS allows you to rent your home to your own business for up to 14 days per year, completely tax-free. Here is how this works in practice. You own a business, even a small one, a freelance operation, a side income, a sole proprietorship. You hold a business meeting, a strategy session, a client review at your home. Your business pays you rent for the use of that space. You receive that payment as a homeowner. Under IRC Section 280AG, rental income from your personal residence for 14 days or fewer per year is completely excluded from your gross income. The business deducts the payment as a business expense. You receive it tax-free. A reasonable rental rate for a meeting space in most cities runs $500 to $2,000 per day. 14 days at $800 per day is $11,200. Your business deducts $11,200. You receive $11,200 tax-free. The net tax benefit, depending on your bracket, is $2,500 to $4,100 in a single year from one rule that you can use every year. The insight. The Augusta Rule is named after Augusta, Georgia, where homeowners near the Masters Golf Tournament rent their homes to corporations for tournament week and pay 0 federal income tax on the rental income. The rule was written for them. It applies to you. Same code, same country, different awareness. But wait, Cheat Code 2 is the one that works even if you never own a business. Don't skip it. Cheat Code 2, the Backdoor Roth, a fully legal 2-step process that allows high earners and anyone else to contribute to a Roth IRA, even when the income limits say they can't. Here is the standard version of events. The Roth IRA is one of the most powerful retirement accounts available. Contributions grow tax-free, withdrawals in retirement are tax-free, and there are no required minimum distributions. The problem, if you earn above $161,000 as a single filer in 2025, you cannot contribute directly. The IRS phases you out. The backdoor version works like this. You contribute to a traditional IRA, which has no income limit for contributions, only for deductions. The contribution goes in as after-tax money, meaning you already paid income tax on it. Then you convert that traditional IRA to a Roth IRA, because the money was already taxed. The conversion triggers little to no additional tax. You now have money inside a Roth IRA, tax-free growth, tax-free withdrawal, despite being over the income limit. The IRS has explicitly stated this strategy is legal. It is documented. It is used by millions of Americans. The back door is not a secret. It is an unlocked door that most people walk past because they think the main entrance is the only entrance. The insight. The contribution limit for a Roth IRA in 2025 is $7,000 per year, $8,000 if you are 50 or older. Over 20 years, $7,000 per year, growing at 8% annual return, generates approximately $346,000, all of it withdrawn tax-free in retirement. The backdoor does not change the destination, it removes the roadblock. This next one, Cheat Code 3, is the one that shocks people the most, because it involves a word that sounds illegal, but is completely the opposite. Cheat Code 3. The Depreciation Offset. The IRS allows you to deduct the theoretical aging of an asset you own, reducing your taxable income without spending a single additional dollar. Here is the mechanism. When you own income-producing real property, a rental unit, a commercial space, the IRS acknowledges that the physical structure ages and theoretically loses value over time. They allow you to deduct a portion of that theoretical loss annually. For residential real estate, the depreciation period is 27.5 years. For a property worth $275,000, the land value excluded, the annual depreciation deduction is $10,000. You did not spend $10,000. The property did not lose $10,000 in real value. In fact, real estate has historically appreciated, but the IRS gives you a $10,000 paper deduction anyway, against your rental income, against your taxable income, without requiring you to spend anything. A real estate investor earning $30,000 in rental income can reduce that taxable rental income to $20,000 using depreciation alone. At a 22% tax bracket, that is $2,200 in taxes not paid every single year, without writing a check, without making a business decision. The asset generates the deduction automatically. The insight. This is how real estate investors report owning profitable properties while showing tax losses on paper. The cash flow is real and positive. The taxable income is reduced to near zero through depreciation. It is not a trick. It is the mechanical reality of the tax code applied correctly. We are past the halfway point. Cheat Code 4 is specifically for anyone who earns any income from their own work, freelance, consulting, content creation, anything self-employed. This one is the most universally applicable. Do not move yet. Cheat Code 4, the QBI deduction. Self-employed individuals and small business owners can deduct up to 20% of their qualified business income, directly reducing taxable income, using a provision most people have never heard of. Section 199A of the tax code, introduced in 2018, created the qualified business income deduction. If you are a sole proprietor, a freelancer, an independent contractor, a single-member LLC, or an S-corporation owner, you may qualify to deduct up to 20% of your net business income from your taxable income, not from your tax bill, from your taxable income, which then reduces your tax bill. At $60,000 in self-employment income, a 20% QBI deduction removes $12,000 from your taxable income. At a 22% tax rate, that is $2,640 in taxes not owed. For someone earning $100,000 in business income, the deduction is worth up to $4,400 per year in tax savings. The qualification rules have income thresholds and business type requirements, but for most standard service businesses and freelance operations below $191,950 in taxable income as a single filer in 2025, the full 20% deduction applies automatically. The insight, the QBI deduction, was written to benefit small business owners and the self-employed. It is one of the largest tax breaks created in the last 30 years. It is used by a fraction of the people who qualify for it, because most people filing as self-employed either do not know it exists or do not claim it correctly. The deduction does not require additional spending. It requires correct filing. The final cheat code is the one I told you to stay for at the beginning. It is the only one on this list that works at almost any income level, including zero, and it is the reason some people report $150,000 in income and owe almost nothing. Cheat Code 5, the zero tax architecture. By combining tax-advantaged accounts, deductions, and the standard deduction, it is mathematically possible to earn $50,000 to $80,000 and owe zero federal income tax legally using the standard tax code. Here is the construction. Starting income, $60,000. Step 1. Contribute the maximum to a traditional 401k, $23,500 in 2025. That reduces gross income to $36,500. Step 2. Contribute the maximum to a health savings account, $4,150 for an individual. Gross income now, $32,350. Step 3. Apply the standard deduction for a single filer in 2025, $15,000. Taxable income, $17,350. Step 4. Apply the QBI deduction if self-employed 20% of business income. Taxable income falls further. Step 5. Apply any applicable above-the-line deductions: student loan interest, self-employment tax deduction, educator expenses. The result, with disciplined stacking of contributions that are available to most working adults, is a taxable income low enough to fall entirely within the 10% bracket or below the threshold entirely. The money contributed to the 401k and HSA was not spent. It was redirected into accounts that grow tax-advantaged. The deductions were not fabricated. They are the standard deductions available to every single filer in the country. The people who pay nothing on significant incomes are not cheating. They are stacking legally available tools in the correct sequence. The sequence is the cheat code, the insight. The US tax code contains over 70,000 pages. The standard filing form uses approximately 0.003% of those pages. The rest contains deductions, credits, exclusions, and provisions that apply to specific situations and that most people never encounter because the standard path does not surface them. The zero tax architecture is not for the ultra-wealthy only. It is a construction that works at income levels most of this channel's viewers are at right now. Let me connect all 5 cheat codes into one system, because used together, they do not add up linearly, they multiply. The Augusta Rule redirects business money to you tax-free. The Backdoor Roth builds tax-free retirement wealth regardless of income. Depreciation offsets rental income with a paper deduction that costs nothing. The QBI Deduction removes 20% of self-employment income from taxation automatically. And the zero tax architecture stacks all available tools in the correct sequence to drive taxable income towards zero. Individually, each cheat code saves $2,000 to $11,000 per year. Combined and applied in sequence, this is what I call the legal tax stack. The total annual tax reduction can exceed $30,000 for someone earning $80,000 to $120,000. Not theoretical, not hypothetical, mathematical, based on published tax code provisions that exist right now. Now here is the objection I know you are carrying, but I don't own a business. I don't own real estate. I'm just a regular employee. Start with cheat code 2. The Backdoor Roth requires no business, no property, no special status. It requires a brokerage account and 2 steps. Then earn $1 of self-employment income, 1 freelance project, 1 consulting call, 1 piece of content monetized, and cheat code 4 opens. The stack builds from whatever position you are currently in. You do not need all 5 today. You need the next one. The tax code was written with these provisions in it. They were not put there by accident. They were put there to reward specific financial behaviors, owning assets, building businesses, saving for retirement, protecting health. Engage in those behaviors, use the tools built for them, and the tax code begins working for you rather than against you. That is not cheating. That is reading the game manual. So now you know the 5 legal cheat codes in the tax system: the Augusta Rule, the Backdoor Roth, depreciation, the QBI deduction, and the zero tax architecture. None of these require breaking the law. None require an expensive tax attorney to access. All 5 are in the same document you already file under. The only difference between the people who use them and the people who don't is the map. You just got the map. Here is what I want you to do right now. Comment one word, cheat code, just that. If this video showed you something about the tax system you had never seen before, comment those 2 words. I read every single one, and the cheat code that gets mentioned most in the comments gets its own full deep dive video, step-by-step implementation, exact forms, exact numbers. If this video hit different, subscribe. Every week on this channel, we take the financial systems that were built without your instruction manual, and we hand you the manual, level by level, code by code. No generic advice. No, just save more money. Just the map. And if you want to understand how the people who've already implemented this live differently, what their actual financial architecture looks like from the inside, that video is right here. Watch it next. The cheat codes were always there. Now you know where to look.